Hi, everybody, and welcome back to video number 4 in chapter 1. I thought it would be good to take a little break from the PowerPoints and take a look at yahoo.finance.com in the Work the Web section of chapter 1. And I'm not going to go through all of it, but I thought I would show you what American Express looks like because that's the second question on page 16 as to what you can see. And I think it would be really good for you guys to take a little time and just uh, page through what's available out there from the standpoint of kind of getting to know stocks and how they work and some of the uh, earnings trends and analytical insights and other things that are available here. So as I scroll down this little thing for a second, you can see that it gives you revenue earnings and analyst recommendations, the latest rating, what that date is, and they give you some statistics. But they ask you in the text to go to the uh, uh, statistics tab. So I'm going to do that just to show you. And here you can get all sorts of statistics for the American Express Company. You have to know their ticker symbol here to get that information, and you just search for it up here in Yahoo Finance. And they talk about Papa John's, they talk about Harley Davidson, Southwest Airlines, and Anheuser-Busch. And you can take a look at those, and I encourage you to do so just to get an idea as to what's out there and how these stocks would vary between those organizations. But they also ask you about um, some of the statistics uh, abbreviations, and I want to show you where to find that. As I go down here, you can see financial highlights and trading information and lots of interesting stuff. But here is the abbreviation guide. And the MRQ is the most recent quarter. TTM is the trailing 12 months. YOY is year over year. LFY is last fiscal year. And FYE is fiscal year ending. So those are what they're asking for in question number 2. Anyway, I thought that was useful information. And I hope you'll take the time to kind of go through that. I don't have the time in this video to do all that for you, but I think you'll find it very interesting. And of course, bring any questions you have to me, and we'll try to get to the bottom of them. Okay, we'll quit here and go back to the PowerPoint. Okay, when we left off from video 3, we were talking about proxy fights and takeovers, and there can be, as I mentioned, hostile uh, takeovers when one group wants to get rid of, say, a management that they feel is not doing the job. Anyway, um, stakeholders. Management and stockholders are, of course, the ones you think of most likely as stakeholders in the corporation, but they're not the only parties with an interest in the firm's decision. Certainly, your employees, I certainly was interested in the company, customers, suppliers, or even the government. We all have a financial interest in the firm. Now, so a stakeholder then is someone other than a stockholder or creditor who potentially has a claim on the cash flows of the firm. I mentioned earlier that this course generally is going to focus on cash. And such groups will attempt to exert control over the firm, sometimes to the detriment of the owners. I know for in my case, I would have loved to have had $1 million salary, but the position I held didn't command that kind of a salary. Okay, so that brings us then to the questions for this segment. And the first one is concept question is what is the agency relationship? And as you will remember, that's the relationship between the stockholders and management. And then what are agency problems and how do they come about? What are the agency's costs? Well, there's often, I won't say often, there can exist conflict between the stockholders and management. That's the agency problem. But we have costs associated with that conflict, which are divided into a direct and indirect costs when there is a need to resolve those kinds of problems and the costs associated with those. Of course, the text goes into far more detail on that, which I encourage you. And if I hadn't mentioned it earlier, um, going through the PowerPoint is just an overview of the chapter and really is not sufficient to really understand the chapter. You need to read it carefully after you've gone through the overview with me. And then in the third question, it asks, what incentives do managers in large corporations have to maximize share value? Well, there were lots of different ways that that can come about. I know in my case, I had a bonus at Chrysler, and that was based on three factors. Um, Certainly, profitability was one of them, quality of the product coming out, over which I didn't have any control, I might add. I mean, I was a finance guy. Um, and then there were some other factors too, including your review and how well you did. So those are some ways that you can do it. But the big one I think that they used in the textbook, which is one you want to know, are RSUs or restrictive stock units. And those have a, a time by which they will be come into effect. So that's often called a vesting period. And that vesting period, then you're entitled to purchase those stocks. Encourage you to read that in the textbook on restrictive stock units, and I think it'll give you a good example of what it is and how it can be used. Okay. Next, we talk about the financial markets and the corporation. So, a financial market is just a way of bringing buyers and sellers together to buy and sell debt and equity securities. So, the most important differences between financial markets concerns the type of securities that are traded, how the trading is conducted, and who the buyers and sellers are. So, as this chapter is a little definitional, you'll want to know these definitions for sure. Here, a primary versus the secondary market. In the primary market, that's when the corporation sells its stock and raises money for the corporation. Then, once it's out in the real world, I'll bounce down to here. In the secondary market, if I own some stock, I can sell it to another person, and they can sell it to another person, and they can sell it to another person. Um, the company doesn't get involved in that. The company is only interested in the primary market transaction. And these public offerings involve selling securities to the general public, a publicly traded company subject to um, SEC and SOX and that kind of thing. But also there's private corporations, and they're negotiated, in this case, sales involving a specific buyer. And that can be either for a publicly traded company or a privately traded company. So these private placements are negotiated sales involving a specific buyer. I have 450,000 shares, for example, in a privately traded corporation called Vehicle Research Corporation. And if you wanted to get some shares of stock, you'd have to buy it from one of the 8 shareholders, I being one. Okay, and I talked a little bit here about the secondary market, and that serves as a means of transferring ownership of corporate securities. Okay, so this is a little bit difficult to understand, this particular diagram, so I'll go through it a little bit. Here, the firm issues security to raise cash. Here it is here. And then the firm invests in its assets here. And then the firm's operations then generate, let's call it increased cash flow here under C. And that cash flow is paid to the government in the way of taxes, and it's paid to our other stakeholders, usually our accounts payable people. And then under Echo here, the reinvested cash flows are plowed back into the corporation. And then again, cash is paid out to investors in the form of interest and dividends here. Okay. All right. There are 2 types of secondary markets. The dealer markets in stock and long-term debt are called over-the-counter markets, OTC, meaning the dealers are connected electronically instead of transacting in a central location. So that's usually where the little guys reside. Then we have auction markets, and they differ from dealer markets in 2 ways. An auction market has a physical location. Okay? The primary purpose is to match those who wish to sell with those who wish to buy, with dealers playing a limited role. Whereas most of the buying and selling is done by a dealer in a dealer market. So the largest organized auction market is the New York Stock Exchange. And while a large OTC market, often called NASDAQ, exists for stocks. So again, this chapter focuses on definitions. So you want to know these. They're used pretty often when we talk about stocks, which we will more in this course. Stocks that trade on an organized exchange are said to be listed on that exchange, with exchanges having different criteria. For example, asset size, number of shareholders, etc. All right, so the concept questions we already went through. What are the major areas of finance? Hopefully you can answer those now. What is the capital budgeting decision? What do you call the specific mixture of long-term debt and equity that firm chooses to use? What are the 3 forms of the business organization? Why is the corporate form superior when it comes to raising cash? What are agency problems and how do they come about? And what are agency costs? What is the dealer market? And how do dealer auction markets differ? So we didn't talk about the dealer market, and we just did, of course. That's going to be your over-the-counter transactions. And then auction markets are going to be things like the New York Stock Exchange. Okay, that looks like we've ended chapter 1. And when we continue, we'll take a look at chapter 2. Until that time, bye for now.